Hello everyone, welcome back to Upside Down Data. Today I want to talk about a macro risk to crypto and how likely that potential risk could be from a data-driven perspective. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So with Bitcoin having a bit of weakness in its price action more recently, it's kind of corrected quite a bit off of its all-time high. There have been a lot of narratives that have been springing up about kind of why people think Bitcoin's going to collapse further. There's obviously always bear narratives in crypto, but now with the weakness in Bitcoin's price action, those bears have become more vocal and are bringing up all these reasons why they think a big crash is imminent. And what a lot of it kind of revolves around is not necessarily so much about Bitcoin itself, or at least some of the narratives aren't necessarily so much about Bitcoin itself, but more about things extrinsic to Bitcoin, things outside of Bitcoin that could happen that would just pull down Bitcoin along with it. And one of the narratives that I've been hearing a lot, kind of on crypto Twitter, I've been seeing a lot, is this idea that we're bound for a stock market collapse, a stock market crash, which will then drag down all of crypto with it. And then people are calling for, super low crypto valuations, valuations of Bitcoin, and certainly for altcoins as a result of this. And so what I want to talk about today is, from a data-driven perspective, how likely is a stock market crash right now based on what we've seen throughout history, the history of the stock market, and when corrections have happened or big kind of crashes have happened. And my thesis is that, personally, I do not think that anything within Bitcoin itself is going to be responsible if it fails to hold support at its current levels at around 55K or so as I'm recording this, 54, 55. I think that a weakness in something like the stock market would be the thing that would cause it to collapse, and that's why I think it's important for us to consider how likely is such a thing to actually happen. Some people are saying that it's guaranteed to happen almost, the way they're acting. I want to take a more data-driven approach to answer this question. So first, just to get to my point where I don't think anything internal to crypto is a particular threat right now, I think it's useful to look back at Bitcoin's risk levels throughout history and see when big corrections have historically happened and what had been going on with Bitcoin's risk before those things happened. So here I'm showing you our risk indicator for Bitcoin across its price history, the price in logarithmic form, and each dot is a day that's color-coded based on the output of a risk model. So 5 is high risk, -5 is low risk. And what you can see just by looking at this chart is that every time we've gotten one of these major corrections in Bitcoin's history, the UDPI has always flashed red. It's always gotten up to these high levels of risk. In fact, it's always gotten above 4 before one of these big corrections has happened. And we just haven't seen that yet. We've gotten up into the kind of the light oranges here. We haven't gotten to these extreme red conditions. So it looks more like kind of this type of behavior than it looks like this type of behavior here. So that's just kind of what I'm seeing with here, and also just in confluence with a lot of on-chain data that shows that long-term holders just aren't really selling heavily. There's no capitulation from that group. Number of entities still accumulating. I personally don't see anything internal to crypto that's especially worrisome, or internal to Bitcoin that would suggest that a crash is imminent. Its behavior just hasn't been similar to preceding those crashes that have happened in the past. So if something internal to crypto might not be a likely cause for the crash, I think we need to turn to other things that could happen that maybe could cause that, if we're going to consider whether or not a crash is realistically potentially going to happen or not. And I think where I'm going to turn to, where I think it's useful to look to, is the stock market. And this is going back to those narratives I've been talking about with a lot of bearish narratives that have been coming out about the stock market. How realistic are they from a data-driven perspective? And so what I'm showing you here is actually the upside-downside potential indicator applied to the S&P 500. And this is on the monthly time frame. So each dot here is a month. So this is over many different years here. So you'll see I'm starting the data here in the kind of the early 40s, so after the Great Depression. This was a choice that I made. Essentially, if you let the UDPI, so the UDPI is a smart model. It learns from the data that it's given. If you let it learn from the Great Depression, basically what it does is it gets so kind of traumatized by that event. It's the Great Depression was such an extreme crash that everything after that just looks high risk if you let the model learn from that data there. So you do like up things by about 2 levels here if you let it learn from the Great Depression. And so I'm just making the choice, I'm making the assumption that the Great Depression might be kind of, because it was, almost 100 years ago, I'm just making the assumption that more recent price history might be a little bit more diagnostic, or might just be a little bit more useful to pay attention to in terms of our current risk than including that in the model. Now, obviously, that's an assumption. You could argue a lot of people do believe that we're heading for another event that's going to be as bad or worse than the Great Depression. There's a lot of, bearish sentiment or narratives out there that are saying that. So if you think that's likely, then you would make a different assumption. And essentially, if you think that's likely, all you do is just look at this chart, raise everything up by a couple of risk bands, and that's about what the UDPI would be saying right now in terms of our current risk, if we think that a Great Depression type of crash is possible. It would be a thing that took us 80 years to get to again, or 90 years, but it's not impossible, obviously. I'm just choosing to make the assumption that I think more recent price history might just be more useful to look at to predict more recent price action. And so what you can see is that the UDPI, again, does a great job of identifying these high and low risk points for the S&P 500. So these low risk periods here after these kind of corrections, as well as these high risk periods that tend to precede market corrections. And one of the things that I think is going to stand out immediately when you look at this chart is that we're now back in the red territory. And frankly, I don't think this should be very surprising to anyone who's been following the stock market. It's been the case that ever since the 2008-2009 recession, we had that big crash down into that, and then the UDPI, flashed very low risk. We've been in a pretty steady bull market coming out of that. Pretty steady growth, a little bit of volatility, but not a whole lot coming out of that. And that's only accelerated now coming out of COVID. We've only been kind of exploding even more growth in the stock market coming out of that. And so the idea that the stock market is getting kind of overheated shouldn't be surprising to anyone. I think that's just kind of, we all know. The bigger question is, can the market sustain this level of heat for a long time, or is a correction bound to happen off of this? And I think there's some useful historical examples to look at to try to answer this question. So the two that I think stand out are this big run that the stock market made in the 90s, going into the early 2000s, but then also to look back here in the 50s and 60s at this kind of action here, as these are the two other times in history where we've hit those high-risk red zones. A little bit back here as well, but these kind of being the more major ones. And we can see two different kind of possibilities from a historical perspective of after we've hit these red zones. So one thing that's happened back kind of in the 50s and 60s is that when the market hit those points, might sustain it for about a year, probably that's probably about this, maybe a year or two here before hitting a correction, or just kind of briefly flashing correction, briefly flashing red, correction, briefly flashing red, correction. That's one possibility, that when the market hits this kind of a level, that maybe then a correction will happen, but not a super severe correction, and one that then just kind of resumes the uptrend. If you look at this whole point in the S&P's history, overall, this is just an uptrend. This is just an upward trending market with some volatility in it. So if you stayed in long enough, you're going to be doing quite well. If you just kind of hold through this volatility, it's not really all that scary. Probably the more scary thing to think about is this type of behavior here, where you get this huge correction off of these red zones that takes a long time, for the market to finally snap out and be able to put higher highs. This is kind of this long accumulation that the market put in before it's able to move back up to the upside. But what I think is useful to note about this compared to where we are right now is this took years to happen. The market sat at these risk levels and higher for years back in the mid to late 90s into the 2000s before it had this huge correction. And we haven't done that yet at all. We're just in these red zones now for just a very kind of this point of the history. And if we were to retrace this move that the market did, if we were to put in a similar move to it again, this could be years more at this price, this risk level before we put in a correction. So to put this all together, what this might tell us is that there's two different possibilities from a historical perspective of what could happen, and they have their advantages and disadvantages depending on your perspective, right? So if we engage in this kind of behavior here, where we're kind of going to flash red, then have just kind of a small correction before resuming an uptrend, that's not great for the short term, obviously, because that might suggest that a correction is likely to happen. But then what it would mean is that kind of correction is likely to be short-lived. That instead of being this kind of multi-year downturn before we're ready to move to the upside again, it would just be this kind of brief downturn, maybe throughout a year, half a year, something like that, before we're ready to put more moves back to the upside. And that's, not great from a short-term perspective, but it would mean that the market's not going to have to spend so long correcting before it can move further. Now, if you're more wanting positive things in the short term and you don't care so much about the long term, maybe then you'd want more of this kind of action to happen, where we just keep going nuts in the stock market, hang out in these super high levels of risk for a long time before we have a major correction, but then that would maybe be a multi-year thing where there's just weakness in the market for a long time and this kind of long-lasting sideways action before we're ready to move back to the upside. And so it's really time frame. If you're in it for the short term, this is probably the thing you'd be hoping for, that we don't see a correction soon. And it is possible based on what we've seen in the past. There is precedent for this. But if you're more looking for kind of the long-term health of the market and the ability to maintain an uptrend, then actually seeing a correction here would be healthier for the market from that perspective. But what I think that you can really say from this is, at least from a risk level perspective, based on what we're seeing from our risk model here, it's definitely premature to say that a correction is guaranteed to happen now in the very short term, because we've seen times when the market's been able to sustain super high levels of risk for a long time. And so to say that we're guaranteed to see this kind of action right now, I think it's premature. Obviously we're not in safe territory. We're not in deep green. It is getting a little bit scary, but it's not to say that we're guaranteed to see this kind of correction immediately. We could sustain this theoretically for a long time before seeing a correction. And I think that's an important perspective to have. So with all these people who are pointing to all these bearish narratives, it's not impossible. Obviously, it's not impossible, but it's not guaranteed by any stretch of the imagination. We could just see something like this as well, which could take years before we see a correction. But I do think another important thing to say here is that if we do see this type of behavior that we stay in these risk levels for a really number of years, whatever correction we get is probably going to be a lot more extreme than a correction we get if we just immediately put a correction to the downside. That's what I'm seeing here. I think if we see a correction to the downside, there's no guarantee that we're going to see a big crash like we saw with the housing market crash here, which was kind of a little bit extrinsic to the stock market in general. Not totally, but the housing market crash is not necessarily explicitly tied to the stock market crash, although the two things were obviously correlated to some degree, or there were some. It's not totally different from each other, but it wasn't just that the stock market was getting too overheated that caused that correction. And so I think what I'm going to be thinking is that if we do start seeing a correction here, I just from looking at history, it might be reasonable to expect that it won't be super severe. It's not going to be great. It's not going to feel good, but it might be that we'll be able to recover it from it a little bit more quickly. If we put in a move like this and hang out at high risk levels for a really long time, then when that correction comes, it might be a bit of a bigger one, a much more concerning correction at that point. But those years of the uptrend would be great, obviously. So if one got out at the right time, then one might avoid that kind of cataclysmic fall. But the more overextended the market is, it might be reasonable to expect the worse the correction could be. And we can look at this also just looking at the raw UDPI output over time. So that's what I'm showing you here. And so this right here is what we're seeing back kind of in the 50s and 60s, this kind of hopping up these high-risk zones, correcting, hopping back up to the high-risk zones, correcting, kind of this constant up and down pattern. But the corrections weren't super crazy, and then it was this general uptrend that we were seeing in the market. Whereas this move here in the mid to late 90s going into the early 2000s, here we were hanging out in these high-risk levels for years. But then we saw that massive crash to the downside. And then, of course, the 2008, 2009 crash was really that huge capitulation before we put in this next big run in the bull market that we're seeing right now. So again, the takeaway that I think from here is that there's different possibilities. A correction could happen, but if it does, from history, I think it's reasonable to expect that it won't be nearly severe as if we go and do another move like we did in the 90s. But we could just go and do another move like we did in the 90s. We might just be at this point going into this kind of a move and keep moving to the upside. And then there might be a lot of years of bull run left in us before we do have a correction. But if and when that correction were to happen, maybe it'll be more severe if we saw that kind of price action. But I think just what I do want to say is that none of this is saying that we had to immediately go for a crash. So all the people who are saying that it's guaranteed we're going to be crashing in the next month, I think that's a pretty ridiculous thing to be very confident about. I don't think there's anything I'm seeing here from this more data-driven perspective that's saying that we have to see a correction. Now, obviously, this is all just basing it off of what the risk model is saying, but from the perspective that the risk model has done a pretty good job of identifying these high-risk zones that have preceded corrections, I think it's a useful data point to keep in mind when thinking about what's realistic and what's not. So I'm personally not seeing anything from this perspective that's saying we have to put in a crash, but I'm also not seeing anything that says that that's totally implausible that we could have a correction either. But what I think that is important to say then is like, okay, So what would happen if we did go into a bear market in the stock market, right? What would happen if this bull run were to end? We'd have more sideways action or even kind of some downwards movement in the next year or so. Is that really doom and gloom for crypto? Is that really the end of the line? There's been another narrative I've been seeing a lot on Twitter where people are saying, oh, Bitcoin's only ever existed in a stock market bull market. And what they're trying to imply when they say that is that, get into a stock market bear market and crypto's dead and that Bitcoin's going to zero. That's kind of the implication of that narrative, at least as I interpret it. And so I want to question that narrative as well. Is that actually a reasonable thing to think, that when the stock market is in a bear market that other asset classes can't do well? Is that actually true? So I want to switch over here to TradingView and look at some examples, some historical examples that I think are useful comparing other asset classes and how they performed when the stock market hasn't been doing so well. And I want to draw our attention to this period in the stock market's history back here from the early 70s, so 73 about, to 80s. And this would be kind of the end of this upward movement that we saw here, really leading into the major correction. The stock market hadn't been putting in higher highs throughout all of this. A little bit of a lower low here, but then a higher high. Here's where I put in a lower low and a lower high. So kind of being this downtrend, macro downtrend that took years to come out of, almost a decade to really be able to push out of this kind of sideways action or kind of more bear market here. So what I think is useful to compare then is that there was another asset that wasn't entirely dissimilar to what crypto is right now, although obviously it's different. And that is gold, precious metals. So, obviously to torture a metaphor, people call Bitcoin, a digital gold. That's one of the ways that people see it, kind of this idea of a store of value, much like what gold has been used for throughout the years. And gold trading really kind of caught on or exploded in this same general period from the 70s into the 80s. And I want to just show what gold was able to do while the stock market was not doing well. I just want to show you what gold and then also silver were able to do in this not bullish time for the stock market. So here's gold over that same period. It's parabolic over that time period. Obviously there's a bit of a correction in the mid 70s, but overall, if someone had bought gold at the beginning of that bearish trend in the market and held it through kind of this point up here, at the top of this parabolic run, a 1,200% rise in the value of gold throughout that point. That's not bad for a bear market in the stock market. If you're making 1,200% returns while the stock market isn't returning a positive yield overall over that period, that's pretty great. I don't think you're going to be complaining too much about that. And let's look at silver. Silver did even more impressive move during this time. Silver went up 22, almost 2,300% during that time. And so obviously there's a lot of differences between precious metals and crypto. I'm not trying to say these things are exactly the same. Obviously there's the difference that precious metals have, industrial uses that makes them different. But then obviously crypto has other real world uses that make it useful. So they're not apples to apples by any means, but they are certainly smaller market cap assets relative to equities, relative to the overall stock market, that maybe the money that's not one that if the stock market is doing well, if people don't want to put money in there, maybe they turn to these smaller market cap assets to really try to make big gains. And then you might see these kind of explosions. And so one thing that might be possible with crypto, and again, this is just speculation. We don't, who knows what would happen. But if we were to enter into a more kind of macro bear market phase for the overall stock market, more downward or sideways movement, I think what this suggests is that it doesn't guarantee that Bitcoin is going to collapse or that Bitcoin is going to fail. That we've seen these small cap assets do quite well over those same periods. Now again, that's some speculation and making some assumptions that people would treat crypto or Bitcoin in a similar way that they treated gold and silver back here in the 70s during that stock market bear market. But I do think it's very kind of premature to just assume that it's guaranteed that Bitcoin will have to go to zero or do really horribly through a bear market in the stock market, that Bitcoin can only do well during bull markets in the stock market. I think it could very well be the case that, sure, Bitcoin could have a correction when the stock market corrects at first, but maybe it would actually do quite well off of that. That's possible. So I want to bring this to people's attention, just as a historical example where, these small cap assets have actually been able to do quite well in those kind of bearish phases. So let's go now and just look at where Bitcoin is currently and just think about where it is and what might be reasonable in more of the short term. Now, again, short-term predictions are always very dubious, so I'm not really making anything too ham from this. But what you can see is that for the last while, and this is the daily chart for Bitcoin, it had been kind of in this uptrending channel. This is kind of the channel that it had been in. And one of the things that's happened now more recently is that it looks like we're kind of calling into question this channel a little bit in Bitcoin's more recent actions. As I'm recording it right now, we've kind of pushed down below that trend line. Now, obviously, it depends a little bit how you draw the trend line. It's very easy for you to just take this yellow line here, just shift it slightly, and it still looks pretty reasonable, right? It doesn't look too different. So it's a little bit early to say this is a definitive break of the uptrend. But it still is the case that we're definitely testing the lower bounds of this trend line here. And, the RSI is going down to these lower levels that we've seen kind of in these low points in the market as well. And so that could just be setting us up for a move to the upside. When we've tested this channel before, when the RSI has hit these lower levels, that's tended to precede moves to the upside. So maybe that's just what Bitcoin's doing. It's consolidating at these lower levels, getting ready to push up as well. And it's also kind of testing some of these, moving averages. I'm just going to move this out of the way to see. So, it's kind of been testing the 100-day moving average. That's provided support in these kind of things in the past. We'll just have to see what happens with Bitcoin, if it's able to hold support here or not. But what a lot of people have been talking about is one of the things in the short term that could cause Bitcoin to kind of drop support here, maybe have to fall to some of these lower levels, maybe 48K even, is just weakness in the overall stock market. And so if we look at the S&P 500 at what it's doing right now, a lot of people talk about the 50-day simple moving average as being kind of an important one during bull phases for the S&P 500. It provides kind of support, a lot of bouncing off of it. We've now kind of dropped below it. We're kind of testing it. We're kind of here between the 50-day and the 100-day SMA for the S&P 500. And so we'll just have to watch and see. We have broken through that in September. We came back up. Maybe we're due for another one of those here as well. If there's a lot of weakness in the stock market, that might be one reason why Bitcoin could fall down further. But what I think is important to say with all of this is that this is all just short-term thinking and short-term speculation. And no one knows exactly what's going to happen. It's all just kind of dependent on what happens with the stock market, or who knows, maybe Bitcoin will decouple from the stock market, be able to recover while there's weakness in the S&P 500. Who knows what's going to happen with that. But what I do think is just important to note is that from that more macro perspective we were talking about from the beginning, with the macro levels of risk of the S&P 500, there's nothing to say that if there's weakness in the stock market right here, that it has to lead to this kind of an event like we saw in March of 2020, or perhaps even worse, the kind of event that we saw back here, 2008, 2009, which this is more what some people are calling for in the stock market, this kind of major crash in the stock market. And obviously you can never be definitive about anything, so that's to say that we can't do that. But what I would be saying is that there's nothing about that more macro risk to say that we have to do that immediately. The stock market has ridden hot for a long time in the past, looking back at that move it did in the mid to late 90s and the early 2000s as being a case where we certainly could just see more moves back up to the upside. This could just be temporary weakness before we're ready to move on back up to the upside. And so we're just going to have to wait and see what happens. That's just really going to be what it is. And so obviously, you have to just kind of take it all into account. My perspective with Bitcoin is that, we're still in an uptrend until really proven otherwise. I don't see this as disconfirmation of the uptrend yet at all. And so for now, my thesis is still bullish on Bitcoin. I still think that there's nothing internal to Bitcoin that's going to cause a crash. But obviously, if there's something that's extrinsic, some kind of black swan event or who knows what, that would cause the stock market to crash, that would be one kind of this more extrinsic, more macro perspective risk to Bitcoin. But to think that Bitcoin can't eventually ever recover from that kind of a thing, I think is ridiculous, because we have seen other assets do quite well in stock market bear markets as well. So all of this, none of this is financial advice. You should make your own opinions of where you think the stock market's going, where you think Bitcoin's going, what you think is good investment decisions. Is this a good entry point, or is this just the beginning of something else? That's all up to you to decide. But I did just want to make the more macro point that from my point of view, I think people are getting a little ahead of themselves when they're saying that we're guaranteed to see some kind of a big market crash coming out of this. And we could see temporary weakness, but that doesn't mean that it's preceding some big crash off of that. And so even if we do see some downwards movement in stock market and in crypto, that could definitely happen. That doesn't mean that's going to necessarily be super long-winded. It could all just be part of a more macro uptrend, that even if this uptrend breaks, who cares if this uptrend breaks in some ways? We might come down to some lower levels, But if we're able to eventually then go back up here, if you zoom out then and look at this from a more macro perspective, no one's going to care about those things, right? You know, looking in hindsight, people would just see this as just an overall uptrend and just some temporary weakness. And so I think it's always useful to zoom out and not get too caught up on any one thing. You know, this uptrend is not the end-all be-all for Bitcoin by any means. The bull market could very well continue with this kind of a movement kind of off of it. You know, who knows what's gonna happen. So I think that's just a useful perspective to have. Alright, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with UDPI, we're all going to make it.